and they're raising rates because the economy is growing. That's a good thing. There's a lot of good things going on. The economy is doing very well. Corporate earnings are doing very well. And we are concentrating on all the negative things. And that in itself, I think, is a bullish sign because we don't have euphoria. We don't have
But why the momentum? What do the markets see that leads to this constant upward momentum?
They continually see companies making money, and earnings continue to be better than expected, and we're looking at double-digit earnings growth next year. So what is not to like in the market?
Consumer confidence is strong, too.
Plus consumer confidence and the overall economy, the global economy, a lot of people are thinking that it's moderating. And, well, yeah, but the global PMIs, 85% of global PMIs are in expansion territory. Things are actually good, and we're looking for that negative news. And if you look for the negative news, you'll find it. But things are pretty good.
You know, that's happening at the same time, Jim, that we are finally seeing interest rates rise.
Yep.
The things that the market's saying, okay, 10 years back above 3%, been pretty firmly there. Where do you anticipate that headed?
So that's, reflective of higher long-term growth. And I think that's what's, what's going on right here. And the markets are trying to figure out if the Fed is still accommodative or are they in a wind down mode and do they see the end of this? And then the question for the 10-year yield really is a question of where are we in the cycle? And the narrative is that we're late cycle, and because there's a lot of leverage and there's lots of different reasons that go into that. But there's also business investment, and CapEx has been very, very strong, and the consumer is getting very, very strong. So the signals that would be more towards mid-cycle are actually stronger, in my opinion, than late cycle. So what that means for the 10-year yield is that there's probably more room for it to move higher. Now, how much higher? I think 3.5% would mark the high for the, for this current cycle.
You think we get there in 2019?
It's very, very possible. It depends on what the Fed's trajectory is. If they move above 3%, then I think it's very, very possible that we do that. But it's really hard for me to see the 10-year yield staying above that for any period of time.
You touched on, I think, the key question that investors are thinking about today, which is what is the Fed going to do next? Because if you're looking at economists, they're expecting that you're going to see GDP slow down next year. That this comes off. Does the Fed listen to that and hold back and wait, or do they look at other signals and say, things are very strong here and we need to continue?
Well, that's the key. And I think the one thing that people aren't talking about is the long-term growth rate, which is what the Fed projects to be 1.8% over the long term.
Right.
Could it be that they start to upgrade that forecast in their summary of economic projections? And maybe we're going to find that out later on today. Even if they go from 1.8 to 1.9, what that would signify to the markets is maybe secular stagnation is over.
Would it also signal that rates are going to come faster than the markets anticipate?
It does, and that would push the 10-year yield higher, and that would definitely have a moderating effect on the equity market as well.
Yeah, Karyn, you mentioned that the market's been steadily marching higher because what's happening in the economy, what's happening in earnings, what's happening with consumer and business confidence. But if the market suddenly realizes that the Fed may jack rates up a little faster, does that matter at some point? We've been dealing with such low interest rates for so long.
But it does matter somewhat, but I think that the economy, we're underestimating the strength of the economy. And the tax cuts, this is not a sugar high. This is a fundamental change in business, and that's why we're seeing these confidence numbers, especially in small business. So I think that we're underestimating that. The Fed raising rates because the economy is doing better is actually a good thing.
Do you have targets for the S&P for this year and next?
Well, we're about 2950. We're right on target for that, but we haven't come out with that for next year. Yeah. And we're on target for that. But I think as the average investor is just discounting the fact that the economy is moving forward. And this is something that's working its way through the economy. The small businesses, small business optimism, that's going to continue. The deregulation, it's never been a better time. I mean, people are talking about being entrepreneurs, and Shark Tank has become a verb.
Right.
Shark Tank it. And that's what's really important.
Jim, if we actually see the 10-year move to 3.5%, that changes the calculus for investors at this point. What do you tell people to do?
Well, it does, depending on where growth is, right? So I would argue that economists have been low on their forecasts. They certainly were for 2018. They may be again for 2019. The levers that are being pulled right now is fiscal stimulus with respect to tax reform and also regulatory reform. And Karyn's absolutely right. The small business component of the market it's really, really hard to measure. And I think that's pretty strong, and that's leading a lot of consumer confidence higher. So the market can absorb higher interest rates. So I don't think it has a material effect.